Hi there, I'm Heather Sims. I am a real estate broker in the Dallas-Fort Worth area, and tonight I am about to host a homebuyer webinar, and that is the video that I'm going to show you this week. What I talk about in this homebuyer webinar is basically the biggest mistakes that I see first-time homebuyers making as they start the process of buying their first home. And I'm going to go all through those, talk about how to avoid those mistakes and the best things that you can do to set yourself up for success in the home buying process. So I hope you stay tuned for that. And if you have any questions about the home buying process, I would love for you to get in touch with me and we can have a little consult, just like I'm offering these home buyers in this webinar. I'm happy to talk to you about your personal situation. I have great lenders like the one that is on here with me tonight. Her name is Jennifer Galvan, and she can answer any of your mortgage questions as well. So I hope you enjoy this video, and I hope to see you next week on another edition of All Things Real Estate. Thanks for tuning in. Bye-bye. Okay, thank you all for coming in and joining us this evening. I know that your evenings are cherished, and you've probably been working all day on this Tuesday that feels like a Monday. So I'm Heather Sims. I'm a real estate broker in the Dallas area, and I'm super excited to spend some time with you tonight. Thank you for joining me. Say hi in the chat if you're so inclined. I would like this to be interactive. I hate acting like I'm just talking to everybody. Hello, Derek. There you are. Okay, so here in this webinar tonight, I have Jennifer Galvan here with me. She's a fabulous loan officer. Jennifer, you want to just say hi?
Yep. Hi. I'm local here in the DFW area and happy to be here. So thanks for having me, Heather.
Yeah, absolutely. So what I like to start with is kind of get in our feels a little bit here. I know that, being a first-time home buyer, the prospect of buying a home can be super stressful. It can be very intimidating. It can make you anxious and uncertain. And my goal for tonight is to actually have you leaving this webinar with some good information that makes you feel like this little Zen garden here. I want you to have this feeling of, okay, whew, I got this. Not that, of course, everything is perfect and figured out already, but that you have some basis for feeling good about the home buying process and that you're kind of more educated and kind of ready to go with it. Like I said in the beginning, my name is Heather Sims. I'm a real estate broker in the Dallas area. I've been doing real estate for about 15 years. I opened my own brokerage about 4 years ago. And this is my why, my kids and my husband. I've got kids that just finished their freshman year at Texas A&M University. And they're second generation Aggies. My husband and I are both Aggies too. So they're both down there enjoying their first year of college life. The other thing I want to tell you is that I do have online reviews and that kind of thing. I know that we live in a review society these days. If you're thinking about, going to a hotel, booking a hotel or going to a restaurant or something, the first thing we all do is Google it and look at the reviews. So please do go online, research me. If you're thinking about, possibly talking to me in one of our phone calls or something, I'm happy to have you research me online and find out that I do know what I'm doing, I promise. So let's get to the nitty gritty of what we're going to talk about tonight, and that is first-time home buyer mistakes. After 15 years in the business, I can tell you that buyers really can end up in the wrong house or in the wrong deal. There are ways to avoid that, and that is the good news about that, right? So that's what we're going to walk you through tonight. If any of you are already thinking that you want to go ahead and book a call, you're ready to kind of get going in the process, I would love to chat with you. And here is the link to book a call with me. And if you're lucky, we can get Jennifer on there too with us. So okay, mistake number one, doing all the right things just in the wrong order. And this is where I like to have a little visual here. Little Pinterest fail, right? So I like to tell my buyers that buying a home is kind of like baking a cake. You can have all the right ingredients, but if you mix them up in the wrong order, your goal might be that pretty Pinterest cake that you see right there, but then you end up with something that looks not like a Pinterest cake. You can still eat it, right? It can still taste good, but it's just not exactly what your vision was, and that's what we kind of want to avoid. We want you to have what your vision is. So most home buyers, what they do is they stalk Zillow for months or years. They mentally rule out homes that they could afford because they haven't gone through that pre-approval process. They call a random for sale sign and get a hold of the listing agent instead of having their own representation with a buyer agent. They go to a builder house or an open house. They fall in love with a house, and then they start thinking about, how do I get this house? That leads to stress, lack of confidence, and all those things. So when you find a house and you're not fully prepared to act, what do you do, right? What are you going to do? The recipe that actually works is getting a team in place before you ever really look at homes, and then you go look at homes, right? And what I mean by team is you have a buyer agent picked out, you work with a good lender, and then in that process, you know your numbers. You know what your closing costs are going to be, you know how much down payment you want to put, and you know what you can expect for your monthly payment. When you have that in place, we get the team and you know your numbers, you can go into looking at homes in a much more confident way, and it makes it so much more fun, because buying a home is fun, right? It's exciting. It's something that you should be excited about in your life. What happens when you do it right? You know it's realistic. You know you can move quickly when you find the right house. You avoid emotional rush decisions. You're in control of the process. And don't we just all like to be in control? Of course we do. Okay, let's go on to mistake number 2. And this is probably one of the most common ones that I see is people fall in love with the house itself and forget that the location is not right. There is a reason in real estate that there is that old adage, location, 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 because what I like to tell my buyers is you can renovate the house, but you cannot renovate the street, and you cannot move the house, right? So location is huge. You can renovate the kitchen, you can renovate the primary bath, but you can't do that with the street of the neighborhood. The best way to look for a home is really to choose location first, and do not look at homes outside that radius. If you have a distance to your office that you want to be in, keep that distance. If you have a distance to family or to your church or something like that, make sure that you look within that radius. I actually have some buyers that I've been working with literally for about 1.5 years now, because the husband has a distance that he wants to be from this local golf course, right? So we have picked out literally 3 neighborhoods that are around the golf course that he wants to be close to. And we don't look for anything outside those neighborhoods. And we've been looking for a while, and they're not in any big hurry. So that location really is such a big thing. And the other thing to just take note of is that you want to know what the long-term resale potential could be for the area that the house is in. You don't want to buy something that sort of backs up to a grocery store or something like that, because you don't know what grocery store is going to be like in 10 years. So just know the surroundings and things like that. Bottom line on location is fall in love with that first, and then get the house within that radius. Long term, that is going to serve you much, much better than buying the house with the pretty finishes. Again, I want to share my little call to action here. If you want to book a call with me and possibly with Jennifer, if we get lucky getting her on the line, you are welcome to do that. I'd love to talk to you about your individual situation. Mistake number 3. This is all about the builders out there. Assuming the builder has your back, right? So new construction can actually be a really good thing in this market right now. You walk into a builder home, you see the brand new finishes, everything looks pretty. You've got like the friendly sales lady or the handsome sales dude that know everything about the neighborhood and the houses and things like that. They just look so good, and they smell good, right? It's like that new car smell. This is a new house smell. But here's the thing. What most buyers think is happening is they'll guide you through the process. They'll help me get the best deal. Everything is pretty standard. This could be easier than buying a resale home. But here's the thing. Those people represent the builder. They are called builder reps for a reason, because they represent the builder. They don't represent you. And they're out to get the best deal for the builder, and I don't blame them for that. That's who pays their salary. I'll give you an example about this. So I had a buyer about a month ago that was looking at a new build and had them send him like a good faith estimate of what he would pay at closing. The builder was offering an incentive of $10,000 at closing, which sounds great, right? Well, the lender that they were using that kind of went hand in hand with the builder, the lender was charging a 2% origination fee. And on a $400,000 house, a 2% origination fee is $8,000. So while the builder was giving them a $10,000 incentive at closing, their preferred lender was charging $8,000 to do the loan. So you're left with $2,000. Doesn't sound as good, right? And those things are in the fine print of the builder contracts and things like that. So when I say here that buyers can get caught off guard with things, that's an example of a buyer getting caught off guard with that. And my buyer ended up being like, no, I don't want to do that because it wasn't as good a deal as he thought it was, right? So those surprises in contracts can be a real thing. Limited negotiation or flexibility in terms of, what the builder says you get is what they get. And there's not a lot of negotiation sometimes. The timelines can shift if you're trying to get out of an apartment or something like that. You can be surprised by the timelines. And then those upgrades that you see in those model homes that make them look so pretty, they're expensive. They add up quick. So the smart way to buy new construction really is to have your own representation from the start. Understand the pricing and upgrades from the start. Know what's negotiable and what's not. I mean, can you get stuff thrown in that adds up when you move into a house? Can you get blinds? Can you get a fridge? Can you get washer dryer? Those kind of things. Go in informed. Be excited, but go in informed. That's important to know. Mistake number 4 is something that is so common, and I will tell you from my standpoint, I get intimidated by the numbers. I know Jennifer doesn't because she deals with numbers every day. I'm not an accountant, and there's a reason because I don't like numbers that much. But it is so important when you're looking at buying a home to know your numbers. Let me tell you too, that team that I talked about earlier, it doesn't cost you any money up front to have a good buyer agent and a good lender on your side. The buyer agent, for you to be represented by a buyer agent, typically costs you personally nothing, even at closing. Typically the seller or the builder, 99% of the time, pays the buyer agent services. And then a lender's not going to cost you any money until closing. And that's when they actually do your loan. Okay, so let's talk about numbers in 2 different ways tonight. I want to talk about money during the contract, and then I want to talk about money for closing. So money during the contract, you're going to have, when you sign a contract, you're going to have your option money and your earnest money. Your option money is kind of your get out of jail free card. If you decide that after you contract on the home that you want to get out, all you lose is your option money. That's typically about $200 to $400, depending on your negotiated amount. And that's for 5 to 10 days of an inspection period. That's your option period. Earnest money is typically 1% of the loan. So let's use that $400,000 number again for round numbers. You're talking about $4,000 up front. You get those credited to you at closing. Option money is non-refundable. Earnest money is refundable up to a certain point. It's refundable up to your option period ending. After your option period is in play, you still have some days for financing and things like that in there, but let's not get bogged down by that. But let's just say option money is not refundable. Earnest money typically is. And then you're also going to want to do inspections on the house, right? So a general inspection is $400 to $600. A pest inspection is typically around $150. When you are under contract, what we want to do during that first 5 to 10 days of your option period is get a good faith estimate from your lender and also get a monthly payment estimate from your lender. That is going to, you're going to have an idea of that if you work with me or with Jennifer or with a good buyer agent or lender, even if it's not us. You're going to know those numbers pretty much before, but once you get a contract, you can actually really run those numbers and know exactly what those are, so that if you get any surprises for any reason, you can know during the option period and you can pull out and not put that earnest money into play. After we do the initial inspections and that option period and things like that, all you have left before closing is going to be your appraisal, and typically that's about $500 to $700. That is also non-refundable money. After all of that, it kind of goes quiet. The title company and the lender are doing all their due diligence on your stuff. If you buy a house in an HOA, you'll get the HOA documents then. During this contract period of time is not the time to go buy anything. Don't buy a fridge, don't buy furniture for the new house, and for God's sake, whatever you do, don't buy a car. You don't want to add any kind of debt to your debt to income ratios. You don't want to mess with that at all. So stay home, eat some beanies and weenies. Don't go anywhere. Don't do anything fun until closing. Okay, let's go over the contract costs again real quick. Option money, $200. Earnest money, $4,000. The total on that is $4,200. You do get credited for that at closing if you close. So you're not losing that money. That money is credited to you at closing. Your inspection and appraisal fees are not credited to you at closing, but they're your due diligence money. It's hard to say fast. Due diligence money. And what I put on there is true. It's a credit to you for being smart in the home buying process and doing those inspections and appraisals. Okay. Closing costs. What do you pay at closing? This is something I get asked so many times. Okay, there's two sets of money at closing. There's your down payment, which can be anywhere from 0% to 20% to more than 20%. So it really does matter as far as like what you're comfortable with financially and what kind of loan that you get. And Jennifer will talk about those in a little while. Then you have also your closing costs. Those are made up of your general fees to the title company, the lender. They have your loan fees. Remember the loan origination thing I was talking about earlier? That's where that is. And then you have what's called prepaids. That's to set up your tax escrow account and your insurance escrow account within your mortgage payment. So those are the things that you have at closing. Here's my other shameless plug. If you want to book a call with me and with Jennifer, if you're thinking, okay, I know I need help with finding out the numbers and finding a great house. So book a call with us and we will help you. Okay, mistake number 5. So what I like to tell people is I know enough about lending to be dangerous. So this is the time that I'm going to turn this presentation for the next few slides over to Jennifer, and she's going to go over the loan programs with you. And Jennifer, just let me know when you want the slides advanced. Are you there? Got to try your microphone.
Sorry, there we go.
There you are.
Okay, awesome.
There you are.
Yeah.
Okay, we got it.
Thank you so much. So not using the right loan program. Yeah, absolutely. This is great info. And so why choose, and let me make sure I can't see the full slide. So let me.
Oh, you can't?
It's because my camera, I just need to move it somehow. I think it's okay.
I thought it was something with the.
Oh, there we go. Maybe, when I exited out of the chat, it helped. Okay. So using somebody local in your market, I have seen, a lot of these online lenders that, are not in touch with the market. I've seen some crazy quotes where it's like, 1% for taxes and 0.2% for insurance. And it's like, you don't know our market. That's not what goes on here. We don't have that kind of, tax rate. We don't have that kind of insurance rate. So having somebody that can get you good, estimates up front so you know what to expect, that knows the market is really great, and to have somebody like that in your corner. You have a dedicated person. So I'm actually a broker, which means I work with several lenders to get the best lender for your product. If you go to a local bank, they have a box and it's like, if you don't have, this credit score or these things, you don't fit in our box, we can't approve you. Whereas I have lenders that do all different types of programs and can have lots of different boxes. So we can help you no matter what. So also you're going to talk to somebody who will be able to respond. So a lot of times with some of these big online lenders, you're going to wait several days to get a response. That person's out of office. That person, went on vacation. The other person forgot to, check that file, or they're checking all these other files. So it can be a run. You can get the runaround really easily. Whereas when you work with a local loan originator and even, broker like me, you're going to have somebody that is going to be available and ready to help. So faster communication, clearer answers, we have, an underwriting team that we, know what they're going to ask for. I could pretty much underwrite the file myself. Like I know the guidelines, I know what is going to be needed. So you're not going to have as many surprises. Now, sometimes there's something unavoidable, like you didn't realize, the transcript was going to say this until you pulled it. But most of that stuff is unavoidable, but we're going to make sure that the things that we can do our due diligence on, we do, and we get you fully approved. Smoother process from contract to closing. When I do a pre-approval, we do a pre-underwrite basically. So, some lenders, they'll just say, well, what do you think you make? They'll pull your credit score. They'll just give you an approval. Whereas we are actually going to run underwriting on it. So there's something called AUS, a computer underwriter. It's called the automated underwriting system. And it is a computer underwriter that Fannie Mae and Freddie Mac have, established. Any loan, conventional FHA, VA, or USDA in the United States has to be run through AUS. So I'm going to run AUS before you even get into contract. I'm going to give you a full pre-approval that is solid. And that can be a huge difference. You're not going to get into contract and then be brokenhearted when you all of a sudden got denied and you could chance losing your earnest money, costly, inspections. It can be, it can be a lot of cost. So working with somebody that, is going to do their due diligence and give you a solid pre-approval is huge. We also have lots of first-time homebuyer products. Again, some of our lenders, will only sign up with certain people. If Chase Bank doesn't sign up with these, groups, then you can't, have that program. Whereas we have a lot more flexibility of signing up with different programs. You can go to the next slide. So we'll talk about some of those programs now. So and what is a first-time home buyer? So, when we say first-time home buyer, that means you have not been on the deed of a home. So you haven't, had your name on a deed in more than 3 years. Now, if you, have had some special cases where, they were on the deed of a parent that, had died and they didn't actually live there, it wasn't actually them. So there's some, caveats to that. But if you haven't owned a home in more than 3 years, you're now, again, a first-time home buyer. And we have, a lot of great programs. Even if you're not going to do like a down payment assistance, we still have first-time home buyer programs that give you better pricing, better mortgage insurance premiums, better approval ratings, lower down payment options, and again, better pricing where what we call LLPAs, loan level pricing adjustments. Those can be waived when you're a first-time home buyer. Some of those do have some income limits, some of them don't. So we look at all of those things when we see if you would qualify for all these different programs we have. Now, there are different, I'm going to go through some of these other first-time home buyer programs because we'll talk about some of these that require you, to not sell the home or you have to pay it back. So I can show you some of those as we go to the next slide. So go ahead and go to the next slide. So these are some examples. In that last slide, like it said, there was some different caveats to first-time homebuyer programs. So this is a DPA, what we call DPA, down payment assistance loan. So when, Heather did a great job of pointing out the three main buckets in closing costs, but you have your down payment and you have your closing costs, and prepaids and stuff will roll into that closing cost category. So you have closing costs, you have down payment. The law says, and a lot of these regulations started after the subprime mortgage crisis to protect our financing industry and all that. Sorry. When you have down payment, you as the home buyer are required. So the down payment requirements will range from 3% up to 5%, the minimum requirement, depending on your loan type. Actually, we can say 0% up to 5%, depending on the loan type. And I'll go over those specifics in a minute. But that down payment has to come from you. Or it can be, the caveat to that is, or it can be a approvable family member, gift funds from a family member, and different loan types specify that. Like a godparent does qualify on some loan types, a significant other does qualify on some loan types. So you can have, gift funds from a family member, or you can have a government. Actually, it doesn't have to be a government. You have to have a approvable grant or down payment assistance program, and the lender will verify. I've had some people who had like Catholic Charities or some other places like that did give them down payment assistance as long as they qualify under an organization, that is allowed to give down payment assistance. So a lot of those are government programs, but there are other nonprofits. So that program, and you would know that in advance of, okay, does this program, is it an eligible down payment assistance? And the reason I say that is because your down payment, if you have a down payment, being covered by only those particular things. Seller's concessions is very big right now. Like, in fact, I have 7 active contracts right now, and between me and my teammate, and all of them have seller concession on them right now. So seller's concessions in this environment are great. But what a lot of people don't realize is they're like, oh, my estimated cash to close is $20,000. I'm going to get $20,000 in seller concession. I'm good. No, it doesn't quite work like that, because you have to provide the down payment or from those 2 sources. So the seller's concession can cover your closing costs, but it cannot cover your down payment. Only those qualified buckets that we talked about can cover the down payment.
That's actually a really good point to have a question to have answered up front is from your lender is, how much can I ask for? That's right. Because when you initially make your first offer to a seller for a house, that's when you have sort of the most power. Go ahead and put it all in there. My last buyer that I worked with, we asked for $10,350 up front. And I mean, the seller just signed it, they had to come up with the rest for their actual down payment, but that was the amount of closing costs that they were going to have. So, and we got it covered for them. It's a really good thing to know up front what you can, the max that you can ask for, because you don't want to waste that negotiation.
Exactly. And the different loan types have different qualifications on that. So FHA will allow the most. It'll allow 6% seller's concession, whereas conventional is typically 3%. But if you're putting more down payment down, so instead of like the 5%, you're putting 20%, you could actually do more. And then VA and USDA have some different guidelines on that too. So that's where it's really good to have that upfront pre-approval. And anytime I do a pre-approval, I'm doing a loan quote for the client, so that, you might be approved for $500,000, but the monthly payment you want might be $400,000. So, you want to make sure, like she talked about that option period. Some people, especially when they use these online lenders, they just get a pre-approval. And then during the option period, they actually get their loan estimate, or like you called it earlier, a good faith estimate within their option period. And they're completely shocked, and they cancel because they're like, that's not the payment I wanted. And now you've wasted your time and again, you might be heartbroken because you love the house, but you don't want to do that payment. So yes, exactly. It's another really good point of asking for seller concession and knowing what you need to come out of pocket with. So all of those things, the seller's concession plus down payment, plus, your minus your earnest money deposit, plus your closing costs. When we add all those fees up, at the end of the day, we call it cash to close. So your cash to close, now you're not going to actually bring a money bag into closing, but your cash to close is what is your bottom line out-of-pocket cost after seller's concessions are applied, your earnest money is credited to you, and that gives you a good idea of what to expect. So this grant, there's grant and there's a non-forgivable grant. So this is the TSHAC, and it stands for Texas State Affordable Housing Corporation. It is a state entity. It has different, it ranges from 2% to 5%. It has conventional and FHA and VA loans. And some of the loans are forgivable after 3 years. Some of them are non-forgivable. And you're like, well, why would I want a non-forgivable loan? Well, the non-forgivable ones have a lower rate. So again, we can still see, what do you want in this loan? How much payment can you afford? But counter that with how much down payment you're going to ask for. So, you have to kind of qualify all that and see what works best for you. Credit scores can be 620. The income limits, there are some income limits on this one. And we do have my favorite product called the MCC, the Mortgage Credit Certificate. It can be paired with the down payment aspect of this loan, and that is an amazing tax credit. So at the end of the year, when you're filing, or after, when you're filing your tax returns, you will get some of your interest paid on your mortgage back, either as a refund. Like, so if you get refund, you get a refund from the IRS, you're going to apply that mortgage credit certificate amount. Let's say it's $5,000. So you're going to get $5,000 more on your tax return refund. If you owe taxes because maybe you're self-employed or you have different things going on, it would just be like, let's say you owed $20,000 and your mortgage credit was $5,000, then you're only going to owe $15,000. So it is a great product. You have to be a first-time home buyer. There are some income limits, and the great thing about this product is it goes with it stays with the home. So if you refinance, because they do say people on average will refinance 3 times within the life of living in that home because rates fluctuate so much. So every time you refinance, that mortgage credit certificate stays with your loan, even the refinance loan, until you sell the home or pay it off in full. So less money up front on this because you get, you can get up to 5% down payment assistance. And yeah, there are some really flexible qualifications. Again, you might have a slightly higher interest rate. After the forgivable ones, after 3 years, if you pay off the house, like you sell it or you refinance, you don't have to pay back the down payment assistance. If you don't get the forgivable kind, or you pay it off or refinance before the 3 years are up, you just have to pay back the down payment assistance, but it's not interest accruing. There are some DPA where that, they put it as a second lien and it's accruing interest. This one does not accrue interest. So if you got $10,000 down payment assistance, that's how much you have to pay off in 2 years if you do it early. And when we say pay off, if you do a refinance, you can roll that into the new loan refinanced amount, or if you sell it, it'll just come off of the proceeds from the sale. So you're not like needing to put out $10,000 in advance or anything. It's just, it'll be rolled in or it'll be factored in on the payoff. Okay, let's go to the next one. It should be the TDHCA. The next, this is a happy home buyer. So this is an option.
You want to go back, or you want to go with this one?
No, that's okay, because that's more of a independent, banks program,
Let's do this one.
Which there are some out there like that. So T-Shack is, this is the Homes for Heroes. So if you are a teacher, or you a nurse, or you work in the medical industry other than nursing, but doctors or anything like that, you qualify for this, and it makes the mortgage credit certificate. There's a fee for that. They waive that fee, and there's a little bit better rate options as well. So that's a great option. Go ahead and go to the next one. And so My First Texas Home, this is the TDHCA, and it will be, again, this one is great because it has, less income limits, less stringent income limits. It's very much like T-Shack, but that's the main difference in this one is the income limits can go much higher. And same thing, 2% to 5% down payment assistance, depending on what you want. And you can go ahead and go to the next one. Okay. So then also there are so those are the main, T-Shack and TDHCA are the main Texas ones. There are, different programs out there. I've seen cities that do down payment assistance programs. I've seen, like I said, like some charitable organizations do that. So at the end of the day, we can help you find what's going to be right for you, and get you, in the right product. So I think this one is for you now, right?
Okay. Yeah. Let me take over. I want to talk about one last mistake, and then we'll get to the Q&A section. So, the last mistake I want to talk about is not hiring a gladiator. And what do I mean by the word gladiator? You need a buyer agent that is not there just to open doors. Seeing homes is the easy part. We can all sort of set up appointments and open doors for you. Information is everywhere now. You can get it on Zillow. You can get it on Realtor.com. The real value is what happens around the process, and you need somebody on your side who knows what they're doing and how to get you in the best home with the best programs and things like that. What you really need, and what I mean by being a gladiator, is that you need an agent that helps you make good decisions, that can point out things that you might miss. After years in the business, 15 years, I've seen it all. I know how to deal with things when they get tricky and things like that. You need support is the bottom line. You don't really need more information. You need to know how to interpret problems, how to deal with those problems, and to make decisions with confidence. The gladiator energy that you need is, I want you to feel confident in your decisions, right? I want you to get the best possible outcome for your situation. I want you to avoid the home buyer mistakes we've talked about tonight. And I want the process to feel smooth and clear and actually be fun, right? Because home buying is fun. It's supposed to be. And I like to end this webinar tonight with one of my favorite quotes. It's from Theodore Roosevelt, from The Man in the Arena. And it says, "It's not the critic who counts. The credit belongs to the one who's actually in the arena." When you embark on this home buying process, you're going to get a lot of noise, right? You're going to get a lot of people talking in your ears. But at the end of the day, you're the one doing the thing. You're the one buying the house, and you're the one making the decisions. You're making the investment, and you're living in the outcome. You're living in the home that you purchase, that you choose. So you need that gladiator energy with you. You don't have to do it alone. You need a team behind you, a team that's good, like a good, well-seasoned buyer agent and a good seasoned mortgage broker like Jennifer. So I hope after this presentation that you are feeling a little less stressed out about the home buying process, a little less intimidated, less anxious, and less uncertain, because you have the answers to a lot of the questions that you've probably been struggling with and keeping you up at night, right? So that is basically all we have for you this evening. If you want to stay a little while longer and do some Q&A with Jennifer and I would love to entertain any questions that you guys have.
And let me add, while somebody might be typing their question, let me add one thing. So I get this question a lot. What is the minimum credit score? So we talked about the minimums with the DPA programs, but
yes,
I get
that's a good place to start. Let's start there.
Yes, so what is the minimum credit score? So VA loans are if you served in our military or you're a surviving spouse, and those actually don't have a minimum. But under 580, you will have to put a little bit more down. To be under 580, and then 580 and up, as long as it gets approval through AUS, you're good on a VA loan. FHA, same thing, 580 and up, as long as you get AUS approval. Under 580, you would have to put 10% down. And on USDA, it's 620 or higher, but it's, and same with conventional. So conventional is 620 or higher. Now, I will say that 620 on conventional is hard to get AUS to come through with approval. You have to have a lot of strong, parts like strong assets, strong income, low debt to income. And then also the main thing that so credit score is one question that I get a lot of. The next one is the down payment requirement minimums. So if you're a conventional, doing conventional, and you're a first-time home buyer, you can do 3% instead of 5%. If you're not a first-time home buyer on a conventional, it would be 5%. And these are all primary residences we're talking about. There's some other stuff with investment and stuff like that. Sure. And then on FHA, the required minimum is 3.5%. And one thing that some of my clients do, like house hacking tip, is they will buy a duplex with a FHA loan, and they will live in one side and plan to rent the other side out. And so because they're going to live in one side, it doesn't have to follow the rules of an investment property, which usually requires 20% down. So you can still get into the home with 3.5% down and have a second unit to rent out and have residual income for, but still get in with 3.5%.
That's a great little tip. I like it.
That's good.
I'm gonna tell my kids that when they start buying.
Yes, seriously. Exactly. And so your down payment, those are the minimum requirements. And then also DTI. So the main three things that we qualify you on a loan is DTI, credit score, and how much you're putting down. So the DTI is your debt to income ratio. And what we do is we count all your debts, including the proposed new home payment, divide it by your income, or your income divided by your debts. And then that gives us your debt to income ratio. And then that's a percentage. And so typically on FHA, it can go to 55%. On conventional, it's capped at 50%. On USDA, it's like 42%. They're pretty strict on their DTI. And it has to be the whole household income, even if the person's not going to be on the loan. And then on VA, it doesn't actually have a max. typically 50%, but I've had some, again, as long as it runs through AUS approval, I've had some that went up to 70%. So
Wow.
VA is the best loan product there is, like hands down, as far as
Well
being the
deserved.
best.
Yeah.
Yeah. Yep, being the best for getting that client, that veteran approved. The VA guidelines are all in favor of the veteran. So it's like, do everything you can to get this veteran into the home. So
I want to be mindful of our time. We're at 41 minutes. I want to really go beyond 45, but I wanted to just say, in you talking about DTI and debt to income and percentages and things like that, what I really like to advise my buyers to do is not just get approved for a whole amount. I think you mentioned this earlier too, Jennifer, that you might be approved for 500,000, but it's not comfortable for you and your monthly payment, and so you really want to keep it around 400,000. So what I always tell my buyers is to get an idea of what they can buy with the monthly payment that they're comfortable with, and then maybe do an increment a little bit above that, maybe 25,000 above that and 25,000 below that, so you have a nice range of what you're comfortable with your monthly payment, because really that's how we live. We don't think of, okay, a $500,000 house might be a certain amount, but that's just not what, we can't go on vacation. We can't go out to eat. We can't, go buy fun things or go to concerts or whatever. So you really do live by that monthly payment. And that's what I really stress that people should look at the most. We have time for one more question. Maybe we got a couple more minutes. One of the questions I get a lot with rates fluctuating so much lately, when can someone lock in their rate? And can they lock it in again if things happen during the life of the process of home buying?
Yeah, that's a great question. So there are some companies that will do what we call a lock and shop, where you can have a TBD address, like a to be determined address, like you're not in contract, and you can lock the rate in.
Okay. That's good.
Honestly, they charge an extra fee for that, and I do have lenders that do that. But whenever I price it out, whenever a client wants to do that, it because you have to do a longer lock term, it usually isn't worth it. Now, if it was really volatile and the client really wants to do it, then that's fine. We'll do whatever they want to do, but it doesn't usually pay off to do that. But it is an option. Once you lock in a rate. So let's say you are under contract and you do have a property address, that's when we really can actually submit a loan for a full underwriting approval. Although we do have TBD full underwriting approvals if somebody was like really, wanted to know full certainty. But when we submit it for a full underwrite with the property address of the home you're in contract for, we can lock the rate in. And so what you're talking about is once you lock it in, well, can we, move it with the market?
Do you have like a one-time rate drop during the process or when you lock it in, that's it?
Yeah. So and when my clients ask this, they kind of usually mean two different things. They're either saying like, okay, I locked in a 6% rate, but now I've changed my mind and I want to go down to the 5.875 because my closing costs are less than I thought. So I will pay a little discount points for a lower rate. You can do that with a locked loan. You're locked in, at least with most lenders, and I mean all of my lenders you can. So when I say we're going to lock you in, that means on that day's rate sheet, because rates are like the stock market where they change every day, and actually they can change multiple times a day. Like today we have 3 different rate sheet reprices. So when I lock it in on that, imagine the old school fax machines. We get in a fax machine in the morning with all the rates. This is the rate sheet for today. So if I lock you in on that rate sheet, if you want to go up or down on the rate sheet that's locked in, you can. Now, as far with most lenders, now if you are locked in on the 6% rate and now today's 6% pricing is way better, what we call that is a float down. So you are locked into that rate sheet, but some lenders, not all of them, and like probably I have about 12 lenders and probably about half of them offer this. They'll let you float down. So they'll give you the improvements in the market, with your locked in rate, but they're going to charge a fee for that. So let's say the market improved, and most of my lenders, it's 50 basis points. So when we're talking about rates and pricing, it's in what we call basis points. So let's say the market improved by 100 basis points. They're going to charge a 50 basis points float down fee, and they're going to give you 50 of the improvement. That's better than nothing. Like that, some lenders won't give you anything, but it's not going to be the same as a fresh lock on that day's great pricing. but it's very hard to know. But that's the whole point with locking and not locking is nobody has a crystal ball.
Yeah.
So you have to, decide if you're going to lock, and if the market gets way better, ask those questions up front. Is this lender going to allow a float down?
Yeah. I think that's it. Are we done? We got everything? We got all the questions answered? I think we're right at 46 minutes, which is perfect. Okay. Thank you all for joining us. I hope that you do book a call with us, and we would love to help you.
Can I add on that call? So if you're kind of on the fence and you are not sure, I would just book a call with Heather, and I'll try to be there if I can too. As you can tell, we've got graduation coming up in a crazy week, but we do have options now to do soft credit pulls. So I tell my clients, even if you're not sure, you're like, I'm not going to be ready for a year, you can still get a game plan together and say, okay, here's what we can do a soft pull, so it's not going to impact your credit. We can, talk about what your desire is for monthly payment, and then Heather can set you up on a program where she'll put those parameters for you, and then you can be getting homes to see like what's the market doing and what is my dream home, even if you're still a year away. So even if you're not sure or on the fence, I would definitely book a call with Heather if you have that opportunity.
Book a call with us. There we go. Yeah. Okay. Thank you so much, Jennifer, for joining me in this. And thank you, everyone, for joining. And I'm signing off.
All things real estate. All things real estate.